Hello and welcome to this fresh new edition of Inside Out. It's a show where we focus on individual stocks, in-depth analysis on various stocks, we deep dive into financials, and we also tell you about all the risk as well as the triggers. Hey Sonal.
Hey Nigel, good to be back, right, with more exciting companies to talk about. And of course, not only the metrics that Nigel just mentioned, we'll ask the questions that you, the investors, want to ask. So Nigel, let's talk about the first company on the show today. You have picked up a company which is a recent listing. So before we talk about the fundamentals, tell us how the stock price has fared so far.
Well, Sonal, the company on our radar is Tega Industries. Remember, the company listed in December 2021. And, what the company really aimed at was doing an OFS. So they raised close to around 620 crores odd, in which the promoter entity, that's the Mohankas, they went ahead and they shared some stake. They had a large investor in there as well, Wagner. They exited their entire holdings in this OFS. The issue, well, it saw solid subscription. It was oversubscribed by around 220 times odd. On listing day itself, the stock gapped up. It was up 60-70%, I remember. But from there on, it's hit rough weather and not scaled those highs.
Okay, crazy up move we saw on the listing day, 220 times subscription. So Nigel, that's about the stock move. Explain to us what industry does the company cater to and some background.
Well, the company belongs to the global mill liner industry. Now, a mill liner is needed to run a mill. These products form a part of the mining company's OPEX and not the Capex. So as long as the mill is functioning, well, liners are required. The global industry is expected to grow at a CAGR of around 6% and move from around a $1.8 billion market to nearly a $3 billion market. This growth will be driven by higher demand for copper and other metals due to the electric vehicle manufacturing push. Gold and copper, well, those mill sites in particular, they require superior quality of consumables and they have higher beneficiation requirements. Due to ore grade depletion, miners are required to process more ore to get the desired throughput, which in turn will boost the demand for mineral processing equipment. The global mill liner market is broken down into three broad parts. Tega, remember, they are not present in the biggest part of this, which is the metallic liners market, but that they are addressing to, and we'll get to that bit in just a bit. Now, it's an oligopolistic market with 5 producers capturing close to around 49% of the global market share. Tega's market share in there is close to around 5% of the global mill liner market, and it's the second largest producer of polymer-based mill liners.
Okay, interesting points are there, Nigel. And now that we know something about the industry, let's get in the management and understand more about their business. We are now joined by Tega Industries Managing Director and CEO Mehul Mohanka on the show. Mehul, welcome to the show. Thanks a lot for joining us today. First up, let's talk about the industry. What rate do you estimate the global mill liner industry to grow by, say, in next few years? You right now are at the 5th place globally. What's your target in terms of market share?
The CAGR growth of the mill lining business is about 6% between, I would say, the year 2020 and 2030. And we are, as you rightly said, as per estimates, we are at number 5 in terms of the ranking of market share. And we see ourselves, to grow to roughly around 7 to 8% of the market share from the current 5% in the next 2 years.
Okay, Mr. Mohanka, we'll be coming back to you in just a bit. So, Nigel, we have understood a fair bit about the industry. Mr. Mohanka also gave us some inputs. But let's just talk specifically about Tega's segments, business segments, and also, of course, about its financials.
Well, Sonal, Tega's products, they cater to the aftermarket spend of a mining unit. And they provide a range of products as well as solutions across different stages of mineral processing. Mill liners, well, they contribute bulk of their business, but that as well is divided into traditional mill liners, while they have launched a hybrid mill liner that's known as Dyna Prime. On the non-mill side, they have a mix of wearable components which are critical for mineral processing industry, and they include hydrocyclone, trommel, screening solutions, rapido, as well as conveyor products. On the revenue front, bulk of its business comes in from overseas. But what is more important is that repeat orders constitute nearly around 75%, which gives you a bit of a sense about customer stickiness as well. The company has a quarterly run rate of close to around 250 crores odd, but the margins, they have seen a bit of a downtick in the past few quarters. Well, let's get in Mehul to understand more about that then. Mehul, the order book gives a visibility of little more than 1 quarter. Now, in your industry, is it par for the course, or is a larger order book something that you're working towards?
as you know, we're part of the the consumables or aftermarket space of the mineral processing industry. So for us, our in finished good inventory levels are very low, and there's a very quick turnaround in terms of filling up and fulfilling the orders. So for us, if we carry an order book of in excess of 3 to 4 months, I would say that's hazardous, because then that puts us out in terms of being able to get a product out to customers on time. So at 300 crores, which is roughly 1 quarter's visibility, I would say we're doing pretty well from our industry perspective.
Okay, that is about the order book. But let's talk about margins now. In the past quarter, they were under some pressure and dipped to below that 20% mark. What is the steady margin band you're looking at? Also, what is the margin difference between mill and non-mill business for you?
So we're looking at a steady state operating EBITDA of about 21 to 22%. We've said that repeatedly, that's what we think is sustainable. Margins have been under pressure over the last few quarters because of multiple reasons. There are, for example, abnormal increases in input prices, supply chain challenges in terms of logistic costs post-COVID. Freight costs have been abnormally high. But we've seen that, easing off over the last quarter. So if you look at quarter on quarter, we were at, say, in March 22, we ended with a material margin of about 56%. And we ended June quarter with a material margin of 58.7%, so a slight improvement. But still, if you look at year on year from previous, June quarter 21 to June quarter 22, we're still probably a 1.5% off, still shy. But we see that catching up as material prices continue to ease and logistic supply chain challenges continue to ease over time. In terms of, the non-mill business versus the mill business, I would say the margins are anywhere between 400 to 500 basis points better with the non-mill business vis-a-vis mill. And that's purely to do with the fact that, the non-mill business is still coming off a lower base. The volumes aren't as substantial as in the mill side. And we just, from a non-mill business, since it tends to piggyback the mill business, the costs are lower.
Okay, 21 to 22% is the expected margin band, but let me come across to you again, Nigel. Give us a sense on their existing capacity utilization levels and what are their plans to scale up from here?
Well, Sonal, the current capacity is around 25,000 metric tons odd. That's as of the past quarter. And they're functioning at around 60% capacity utilization. But they have drawn up an ambitious Capex plan of close to around 250 crores. That involves upgrading the Dahej plant, and a larger proportion of that 250 crores will move towards expanding the Chile unit.
Okay, so let me take that question back to Mr. Mohanka. You're at 60% utilization levels currently and are approximately doing 250 crores on a quarterly basis. That's in terms of revenues. So at optimal levels, what revenues can you do subject to demand that is supporting your overall strategy?
So with the new Capex, our capacity will be close to, I would say, on an annualized basis, about 2,000 crores with the additional capacity. And this will help us take care of incremental demand, not only in Chile, that we said the predominant part, 250 crore Capex is going to go into Chile, but other parts of the world as well. So this will take our market share on an upward trajectory the moment we have this capacity come on stream.
Mehul, I wanted some more clarity on this then. Give us the quantum of the total Capex that you're talking about. And also, obviously, we'll want to know what is the funding plan with regard to this?
Our initial outlay is close to about 250 crores with about, I would say 190 crores being spent in building a new plant in Chile because we're running out of capacity and space. So a bulk of that 190 crores in Chile will also go into predominantly, building the infra more than capacity expansion to start with. And we see that come on stream by FY 24-25. Around first quarter. And all the Capex is going to be funded through, a mix of internal accruals and some debt. As you know, we have very low leverage on our balance sheet. So we have an appetite to take on debt, but of course, judiciously.
Mehul, can you quantify the cash in your books in that case?
So about close to 180 odd crores with almost more than 200 crores of cash on our books. So on a net debt perspective, we are negative.
Well, your current capacity is around 25,000 metric tons. What will that move to post the completion of this Capex of 250 crores?
We see our capacity go up from 25,000 metric tons, as of today, to about close to 35,000 tons by the time we're done with our Capex.
Okay, so Nigel, out of its total mill liner revenues, Dyna Prime was a smaller proportion, right, so far, but it is a key trigger for the stock going forward. Why is that?
Well, Sonal, we mentioned earlier that out of the total global mill liner market, around $1 billion was metallic. And in that segment, Tega was not present in. But post the launch of its hybrid mill liner Dyna Prime, they can address this market also, as it is targeted towards mining units, which relied earlier on steel liners. So Dyna Prime unlocks a new addressable market for Tega as they look to convert the existing metallic liner market to its hybrid mill liner. That's Dyna Prime. Well, Mehul, this is the big trigger. Sonal mentioned it. We tried to explain it a little bit. So tell us more about Dyna Prime. What is the scope of growth from here on? Last year, you did around, 230 crores approximately. How big can it get from here? And as a percentage of your revenue mix, what does it move to from around 25%?
Sure. So our current mix of Dyna Prime, as you said, is about 25%. It's a $1 billion market. Our internal CAGR target estimates is between 25 to 30%. Last quarter, we did, I think, close to about 32%. So we beat our own estimates. And given the way Dyna Prime is growing, of course, we see the mix improve from 25% to closer to 35% over the next 3 years. And I think that would still be, a reasonably optimistic number going forward as far as Dyna Prime is concerned.
Okay, Nigel, back to you now. Let's wind this down with valuation risk and shareholding pattern, as you always do.
Well, Sonal, there's no direct listed competitor. But the nearest possible peer comparison is AIA Engineering, though their products are very, very different. The risk, well, they include adverse movements on the currency front, since company has a fair bit of exposure to the global currencies as well. And that's something that dented their performance in Q1 a tad bit. Now, since the company had a collaboration with Swedish firm Tega, they have technological edge. But if there is some bit of disruption on this front, then it will serve as a risk as well. Though currently, they're pretty well placed. Finally, the promoter entity holds close to around 79% stake, and quite a few funds, well, they hold stake in the company. But going ahead, that 79% needs to come down to around that 75%.
Okay, so let me come across to you, Mehul. Your return on capital employed, it has been hovering in mid-teens. Do you have a target here as well? Do you have an ambition to get this number towards that 20% mark?
Yeah, so presently it's about 16% if I was to exclude the non-operating income. And I would like to see it grow to closer to 20% over the next 2 years.
The street will track that very closely, from around 15-16% to around 20%. But final question, Mehul, before we let you go. Promoter holding at around 79%. It needs to come down to around 75%. You have some time, but what are the plans out there?
As you know, the Indian regulators allow us a time period of about 3 years to be able to go down to 75. We do see that, to happen, sooner than 3, because I think we have plans of not only growing aggressively, but as and when there are opportunities which, of bolt-on acquisitions, we would, evaluate those as well. So, I would say that going down to 75 is a given. It's just a matter of, how well we can, identify opportunities for growth and hence raise money to be able to support that.
Okay, Mehul, thanks a lot for joining us today. It was a pleasure having you. And thank you, Nigel, for explaining this to us. A complicated business, a new listing. So it was good to know more details about this business as well. So it's time to slip into a short break now. We'll come back with another interesting stock. A Tata Group company, Nelco, is on the spotlight on the other side. Stay tuned.